The current market conditions in the crypto industry are very tough, and even cryptocurrencies of exciting and promising projects are dumping like crazy. This is also because many of these cryptocurrencies have bad tokenomics. Understanding tokenomics is crucial for every crypto investor to succeed. In today's episode, we will explain how to analyze tokenomics, which will help you to make better strategies and research. But before I forget, please subscribe to this YouTube channel and give this video a like. This triggers the YouTube algorithm and leads to an atom pump on the other hand. And now let us dive deeper into tokenomics.
3, 2, 1.
Here we go!
First of all, what are tokenomics? Tokenomics are an essential part of research in exciting crypto projects. It looks at the economics and incentives behind tokens. You can have the greatest team in tech, but if the tokenomics are bad, the project rarely ends up being a good investment in the long run. You should always look at and understand tokenomics before investing in any cryptocurrency. When you analyze tokenomics on sites like CoinMarketCap or the project's documentation, you will come across many different terms and abbreviations. While they can appear confusing at first sight, we will explain to you all the concepts and terminology you need to know. Let's start with the circulating supply. The circulating supply describes a number of tokens that are currently available on exchanges, sitting around in wallets of DeFi dApps, or are being staked. If we look at Bitcoin, we can see that the circulating supply is 19 millions of the 21 millions which will ever be mined. This leads us to the second term, the maximum supply. This is defined as the maximum number of tokens that will ever be in circulation in the future. For Bitcoin, this is 21 millions. On the other hand, there is no capped supply for other coins and tokens like ETH or Atom. You can calculate the market cap of a project by multiplying the current price with the circulating supply. For example, if Atom is at $10 and the circulating supply is 300 million tokens, the market cap is $3 billion. The fully diluted valuation, also known as FDV, is especially important to consider for tokens with high inflation rates. You can calculate the FDV by multiplying the price with the maximum supply. For example, when Osmo is at $2 and there are 300 million tokens in circulation, the market cap of 600 million may appear low at first sight. However, keep in mind that the maximum supply of Osmo is 1 billion. So, the fully diluted valuation in this example is $2 billion. When you calculate the FDV, it can help you a lot to not be tricked into thinking that some tokens are undervalued just because their market cap is low. The annual percentage rate tells you how much percentage you earn on your deposit every year when you stake your tokens or provide liquidity. For example, if you stake $1,000 worth of Atom and the staking APR is 20%, you will earn $200 over a year. The annual percentage yield, the APY, is derived from the APR. It tells you how much you earn when you compound your staking rewards. Let's look at the example from before. If you compound the staking rewards weekly, you will end up with an APY of 22% instead of 20%. This difference might appear small, but APR and APY can have huge discrepancies for high reward tokens. So, if you have tokens that pay high rates, make sure that you compound them regularly. We also put a link to a helpful APR to APY calculator in the description below. And if you want to use a bot that does the compounding for you, check out our website FRENS.army. Our bots restake your rewards daily and also pay the transaction fee for you. The bonding ratio is very important to understand how high staking rewards are. It tells you how many tokens on the circulating supply are staked. For example, if only 100 millions out of the 300 million atoms in circulations are staked, the bonding ratio is 33%. You can calculate it by dividing the number of tokens staked by the circulating supply. You can get a higher share of the staking rewards when having a lower bonding ratio. For example, if holders stake all 300 million tokens in circulation and the inflation rate is 10%, your staking rewards are also 10%. However, if holders only stake 100 million tokens out of the 300 million tokens and the inflation rate stays constant, your staking rewards will be 30% instead of 10%. You can calculate this by dividing the inflation rate of 10% by the bonding ratio of 33%, which will give you a staking APR of 30%. The last concept you need to know is the so-called vesting schedule. This is important to understand when more tokens will be unlocked and enter circulation. You will often find vesting schedules for the allocations that venture funds, private sales, or project teams hold. These schedules prevent large holders from dumping all their tokens at once. For example, think of an allocation for the core devs of 10 million tokens with a lock of 1 year, followed by a linear vesting schedule of 10 years. No one can sell the tokens during the first year since they are locked. After the first year, 10%, which equals 1 million tokens, are unlocked every year for 10 years. Having heard that tokens are distributed to different parties leads us to the next important topic: token distribution. The token distribution will help you understand who holds how many tokens. This is important because then you can understand if the project is community focused or if most tokens are in hands of venture capitalists, private sale participants who got in at low prices. Let's start with the venture capitalists, angel investors, and project advisors. These parties help early stage projects succeed with funding and their network. In return, they often receive token allocations for very low prices. They can provide value to many projects and many would have failed without them. However, you don't want to see the majority of tokens in their hands for super low prices. Private sales are similar to VC allocations. Typically, they are large investors who provide funding in return for cheap tokens. Again, you do not want to see a huge allocation to private investors because if they hold many tokens and get in at low prices, they are most likely to dump on you and me further down the road. Public sales are the first opportunity for retail investors to come in. The token price in public sales tend to be higher than for VCs, but still lower than the initial listing price on exchanges. Thus, make sure to compare the public sale price to the current price and look at the vesting schedule. With that in mind, you can assess if there's any danger of large token dumps in the future. Most projects also allocate a certain percentage of tokens to their core team and devs. This is important because the core developers should be rewarded for the hard work they have put in. However, be careful with projects that allocate 20% or more to the team. We do not want to see so much supply centralized to a small number of holders. The strategic reserve or community fund of a project can have an extensive range of use cases. If a significant percentage of tokens are allocated to such a reserve or fund, always check the docs or ask in the Discord what precisely they will be used for. We want these tokens to fund initiatives that provide value to the community and ecosystem and not pay some moonboy influences to blindly shield the project. A promising sign for community-focused projects is to airdrop some tokens to their community. This rewards early users, supporters, and retail investors. Also, airdrops help the project onboard users who try out their applications. In the end, mass adoption is what we all aiming for. In the Cosmos ecosystem, many projects started with an airdrop. For example, Osmosis, Juno, and Athmos. This is the main reason why our Cosmos community is so strong. Lastly, with many DeFi tokens, you can find an allocation for liquidity providers. On the one hand, they can help you earn juicy rewards when you provide liquidity on some pools on the protocol. On the other hand, if a significant percentage are LP rewards and there are no suitable demand drivers for the token, most users will just dump them. Speaking of demand drivers, let us look at different use cases a token can have. Understanding what you can use a token for will help you determine if there will be demand for it in the future. If there are no clear use cases, holders will end up selling their tokens over time and prices will continue to decline. However, if you find sustainable and innovative demand drivers, people will buy the token and prices will rise. Many coins of different zones in the Cosmos ecosystem can be used for governance. Your voting power depends on the percentage of tokens you hold. Staking is a primary use case for coins on proof-of-stake chains. By delegating your tokens to validators, for example FRENS Validator, you help secure the network and simultaneously earn staking rewards. You will have to pay a gas fee whenever you perform a transaction or interact with a chain. These gas fees can be extremely high, like on Ethereum, or affordable, like on Athmos. Demand rises if many people use the chain and need the coin to pay for gas. On some DeFi protocols, you will find that holding, staking, or LPing their native token can unlock some benefits for you. These benefits include rebates on transaction fees or boosted yields. The most famous example in the DeFi space is Curve and Convex Wars over on Ethereum. We link you a Twitter thread in the description below if you want to learn more about Curve and how it works. Finally, you can use tokens in DeFi dApps. You can increase buy pressure if there's demand for the token to be used in DeFi. For example, if you get high rewards for lending the token on borrowing and lending protocols like Aave or Umi. With Osmo, we could see demand rising when many people need the token to provide liquidity in pools in which Osmo made up 50%. Speaking of using your tokens, as already mentioned, when staking your cryptocurrencies, you secure the chain and get rewarded for it. On the other hand, you can also earn passive income with your tokens by providing liquidity on DeFi dApps. Earning a passive income with your tokens can become elementary for a good investment. For example, Osmo had a super high inflation rate far above 100% after the protocol launched. However, today, 1 year after Osmosis was launched, the inflation decreased to approximately 77%. The problem? If you hold a highly inflationary token, you lose against the native inflation rate of the project. Because while you just hold your tokens, the circulating supply continues to increase, devaluing the tokens on the other hand. You are dependent on your cryptocurrency to pump significantly, even though the circulating supply of the token you hold gets larger. This is a pretty risky bet. But when providing liquidity or staking your token, you accumulate more tokens, making you more resilient against dumps as the token price may devalue. Still, you have more tokens in your portfolio at the end of the day. Juno and FMOS are two excellent examples. Both tokens have a high inflation rate, but as the staking rewards are pretty high as well, you can counterfight high inflation. In plain words, when holding a highly inflationary token, you should strongly consider staking it. Another thing that is worth mentioning is liquidity providing. Liquidity providing is very useful to increase your passive income stream. However, you must remember that you provide liquidity for a token pair. For example, for Osmo and Juno. Let's say you provide liquidity on Osmosis for this token pair. In this case, you won't earn any rewards in Juno, but Osmo. The problem is that while your Osmo position in your portfolio increases, your Juno position stays the same. That said, you technically lose against the native inflation rate of Juno. When providing liquidity, you must ask yourself to which asset you want to get exposure to. If you want to hold Juno but have more exposure to Osmo, providing liquidity for Juno and Osmo is an excellent strategy. But if you want equal exposure to both Osmo and Juno, staking is most likely the better choice. To wrap things up, tokenomics is one of the most important aspects to look at for every crypto investor. The tokenomics of a crypto project tells you the economic characteristics of a cryptocurrency. For example, the use cases, inflation rate, distribution, and more. Without knowing the tokenomics before investing in a cryptocurrency, you more or less blindly invest in a magic internet coin. Because there are even projects that grow rapidly year by year, but their cryptocurrency performs poorly. But as a project's tokenomics are bad or not very incentivizing, the project's development does not get reflected in the token price. Even though you held the token from the very beginning and the project became big, you still didn't make a significant gain. In plain words, even though you held the token from the very beginning and the project became big, you still didn't make significant gains. In plain words, you were right with the bet on the project, but you do not profit from that financially. Aave, for example, became super big in 2021 and launched on multiple blockchains. Also, the volume increased significantly. However, the Aave token is just a governance token and did not perform too well, even though 2021 was a phenomenal year for Aave. Even though you were right that Aave would become big in 2021, you did not make a good return on your investment. The Aave price action of 2021 is the best example of why looking at tokenomics is essential. However, please note as always that we at FRENS VALIDATOR are no financial advisors. All content is strictly for informational purposes only. None of our statements represents financial advice. But now let us know what you look at when diving deeper into the tokenomics of a crypto project. Comment in the comment section below. Subscribe to this YouTube channel and give this video a like if you want to see atom pumping. And with that being said, I hope I will see you next week.
I mean, the Terra ecosystem was largely made up of Anchor, actually. I remember actually not many weeks before the collapse, I saw someone mention how flourishing it was, how there was so much stuff going on. And I went to the ecosystem page to click through the projects. And I mean, Anchor was the beast, right? It was holding, I don't know, 14 billion USD. And then the next protocol, I don't remember, Mars or Mirror, it was vastly smaller. Like there was, I mean, significant TVL in it for sure. But compared to Anchor, it was nothing. So like you could almost say that Terra was Anchor.